Okay. Well, good afternoon, everyone. Welcome to our next Lunch and Learn Educational. Today, we are going down the digital currency rabbit hole for the crypto curious and learning about the incoming money landscape and the ramifications it's set to have on business. To help us begin this incredibly complex conversation, I'd like to welcome Todd Pierce, who is the Chief Growth Officer at Black Tie Digital. Welcome, Todd.
Thank you so much for having me.
Yeah, pleasure. Now, can you start out by telling us a little bit about yourself, a little bit about Black Tie Digital and the problem you guys are working to solve?
So as you said, with the mouthful of a role, that is my role. I'm the head of growth effectively for Black Tie Digital. And I'm kind of across everything from sales, marketing through to product development, and you name it. If it kind of fits in the growth box, I'll kind of be there. I have been involved in the, I guess, Web3 space for quite some time, dating back to probably 2015, 16 when I first kind of got into it. Back then I had a software company, and my old business partner was, you know, what would they say, head over heels for Bitcoin. And he just said, you have to get this thing, the Bitcoin, right? The Bitcoin. And, you know, like anyone who, I guess, first comes across Bitcoin, you don't necessarily appreciate it as much as you maybe should have, because when I first got, I guess, introduced to it, it was about $900 per token, right? And today it's sitting around the $30,000 mark. So anyway, you live and you learn, right? Hindsight's 2020. So fast forward through the years, I've done a whole range of things from venture capital raising, you know, helping people with their public speaking, coaching, sales companies, all kinds of different things. So I've always been around that sales and marketing kind of space. And when it comes to Black Tie Digital, what we effectively do, right, we're kind of like blockchain / Web3 as a service. So what we do is we look at legacy sectors, if you would, and we kind of see where would there be a fit, right? Because, you know, blockchains are not good for everything. You know, it was like the .com boom, right? Every single company got involved. They said that I'm xyzcompany.com, right? And they got a sky high valuation. So there's been a bit of that with the whole blockchain space, where people just said, hey, we're just going to put it on chain because it's the chain. So we're not like that. We also look, okay, where's there an actual use case? And then we help build that out and apply that. So one thing we're working on right now, which is you can probably see in the background, is Be For Real, which is the integration of the real estate sector here in Australia with Web3. So specifically helping real estate professionals being able to transact with digital currencies, and also helping people that want to buy have new ways to save up money to make purchases, either in full or moving into a pretty exciting spot, which is fractionalized ownership via tokenization. So that's kind of what we do, and that's where we're at. So I hope that answers that question.
So it's such a massive conversation, and it is so complex. So it might be best to start firstly with a little history of money in a nutshell, if that's possible.
Yeah. There's a 60-minute version and a 60-second version. Let's go with the 60-second version. So, you know, I get this question all the time, which is, why should I even care about Web3? Why should I care about crypto? And, you know, why is it not just going to disappear? Like, you know, some pundits seem to think it will. You know, you have to take yourself back in time and look at how money's evolved, and you'll see why this is here to stay. So, you know, money hasn't always been money. You know, we go back to the caves, we had the very first early version of credit systems, right? Where effectively you knew me, I knew you, there was lots of trust, and I would basically put a tally on the wall, and, you know, we'll trade tallies and stuff like that, right? I'll do something for you, you do something for me. Then we started bartering at the same time, so trading goods for goods. But as we grew and became more complex as a society, and effectively the need for trust was there. But once again, how do you trust someone when there's 2,000 people in a community, right? So as we scaled out and distance occurred and the groups grew, we started to do mediums of exchange, right? So we started to put value on objects and would basically use those to facilitate transactions. And we've used lots of things over the years: salt, spices, seashells, stones. Over in Africa, they use little glass beads, right? And what we see when we look back historically is that every single medium of exchange that was basically blown out happened because it lacks some qualities of good money. So good money is typically defined as something that can, hold its value over time. So it's durable. It is a good store of value. You can transport it relatively easily. You can use it as a unit of account. And what we saw, right? So like in Africa, they had these glass beads, which worked well until the Europeans came over with better manufacturing capabilities. And they basically flooded the market with lots of glass beads, devalued the currency, and the whole thing went bust. So we see this evolution over time, right? From more simple objects like that through to metals like copper, silver, gold won because you can't replicate it like you can silver or copper. Gold, has been the gold standard for hundreds and hundreds of years. And, that kind of worked well. The next big thing that we had was coinage. Coinage was massive because it allowed people to transact a lot easier with like a coin standard. And we've always had the same problem throughout history too, if you take a look. And that is typically there are people that find themselves in positions of authority and power that abuse the monetary system. And, we saw this with the collapse of Rome. The emperors, they were basically cutting coins. Well, they would cut the tips of the coins, they would remelt them down and then circulate them with a lower level of gold in them, right? So then, trust drops in a currency and the whole community goes to bust then. So paper money was the next evolution in regards to money. And it was great because what it let you do is it let you spend money without having to actually have the actual goods that the paper represented. So that allowed fast settlement and also a lot of transactions across a distance, especially when you started to have like banks pop up, over here in UK and over in America, and effectively they would transact with each other. So that was really great for a long period of time. But then things changed in the 70s. And what happened is that the whole world went off of the gold standard. Now, the gold standard was a great thing because what it did is it basically kept those that can create money. It created a restriction or a constraint because if they created too much money and they didn't have enough gold to back it, then that could make the whole system collapse. But when we got rid of the gold standard, between 1970 to 2022, an interesting shift has occurred, right? And this kind of ties into why crypto and why this whole thing happened. In the 70s, inflation was not yet high enough that you had to worry about how you can accumulate savings. You could put money into a savings account and you're confident that that will grow into a nest egg for yourself, your family, your kids. Between 1970, when we went off the gold standard, to 1990, so just in 20 years, savings accounts was not good enough. So what people started to do is they'd start investing in bonds, right? So government bonds that would mature over a certain period of time and give you a certain rate of return. By the year 2000 odd, not even bonds were good enough, right? The narrative changed. It's like, hey, if you want to beat inflation, build wealth, you need to get involved in the stock market, right? So the goalpost has kept changing as the quality of our money has decreased, right? And it's decreased massively from the gold standard back in 1971. So go to 2008. For those of us that have got a couple of grays in our hairs, we probably remember what happened back then. But effectively what you had occurring is you had a whole lot of financial shenanigans, right? And, a lot of people don't realize this, but it wasn't just banks giving, low quality applicants loans to buy property. That was like a small piece. So subprime mortgages was one piece of the puzzle. You then had these banks bundling those subprime mortgages, basically using them to get more money from lenders, right? To then give out more money to subprime mortgages. And it was this thing, right? So they would package up thousands of subprime mortgages, give that to a big fund, and then they'd effectively use that money to give out more money to people that really shouldn't be getting it. So it was just an absolute disaster. And there were funds all around the world that were putting money into the American market. And that's why when it collapsed, everything collapsed, right? So in 2008, there was a white paper released. It was the Bitcoin white paper that basically said, hey, we need a better system, or a paraphrase, right? We need a better system. We need something that doesn't require trust. We need something that's decentralized, and we need something that cuts out the middlemen, right? Because it's the middlemen that were making money, all the way through, right? It's the middlemen in the forex markets. It's the middlemen with the banks that make an absolute arm and a leg, while us, the people, suffer from inflation. So that is why Bitcoin was created. And from 2008 to 2022, what we've seen grow, right, is Bitcoin go from less than $1 in value to today, it's over $30,000, right? I think that's in AUD. But you've also seen the space, right, the Web3 space grow as well. You don't just have Bitcoin. Bitcoin is the next evolution of money. What you've then also got is you've got other projects too. You've got Ethereum, right? And what they do is they build decentralized applications. They've created a full ecosystem for developers to come in and build apps that are decentralized that can do a whole range of really cool, unique things, such as decentralized finance, which once again is about you being your own bank. And, you know, NFTs, the whole market, the whole kit and caboodle. So like, that's how we've got here today. It really came from wanting something that's more decentralized, that cuts out the people that can potentially abuse us without us even knowing we're being abused, and giving us that sovereignty and that power back.
That was a great answer. You did it, and it was only slightly more than 60. So blockchain technology, then let's go there, because obviously the whole thing needs support. So
yes,
you did touch on it. What is blockchain technology?
Yeah, so look, blockchain tech is not complicated, even though it sounds complicated. Blockchain technology is just a new way to store data. It's a ledger, right? It's a running ledger that everybody can access and nobody can change. That's all it is. So data gets stored in little blocks. The reason why it's called a cryptocurrency is because you cryptographically secure it, right? So basically we use cryptography to link this block to the next block, and every single block from the Genesis block all the way through to ad nauseum, to wherever it ends, they're all linked, and anyone can go back and see all the transactions that occurred and nobody can change it. That's effectively what blockchain is. It's the layer underneath everything that else that's getting built.
Okay, what is DLT then? What does that stand for, and what does that mean, and how does it differ?
Yeah. DLT is just distributed ledger technology. Once again, that's the decentralization piece. It's about removing it's great in a financial system because, you know, imagine you've got a bank and that bank is the record keeper. They've got the ledger, right? So you can think about the Federal Reserve Bank is like the master ledger in our financial system based on what happened back in 1943, which I won't go there because that's a long story. But they're the master ledger that control all the other ledgers for our financial system. Now, imagine what would happen if that ledger got hacked and corrupted, right? That would be a big problem. That would just cascade out through the system. The cool thing with DLT, or distributed ledger technology, is that effectively I can have the current existing verified accurate ledger on my computer. You can download some software onto your computer, Stacey. You can have a record. You can too, Elise. You can too, Debbie, Ben. We can all have a ledger on our computer, and it's accurate, it's up to date, and it's verified, so we can all see it. If you, for example, Stacey, got hacked and your ledger got corrupted, myself, Debbie, Elise, and Ben, our ledger would basically cancel out your ledger as being inaccurate. So it creates that, what's the word? Confidence. It brings confidence into the system because the bad eggs get cancelled out by the consensus of the whole.
Okay. And they say that crypto is, I guess, a financial leveler for many around the world. So people who don't have access to finance in this, you know, not everybody has equal access. Why is it a good option for the world?
That's actually a really good point in regards to equity. So, you know, one thing that Bitcoin is not, there's a thing called Bitcoin maximalism. Bitcoin maxis are people that basically just hate everything but Bitcoin. Now, on the spectrum of maxiism, I'm like 80%, and I find myself getting more and more every day. But, you know, when you think about what Bitcoin is as a financial instrument, it's not democratic. It's definitely not. It's I'd say, it's a meritocracy. So it's based on merit. You need to output to get a return. You can't just get Bitcoin. It doesn't just pop out of thin air. You need to either mine it, which we'll talk about today, or you need to produce value to be paid in Bitcoin, right? First and foremost. Secondly, it's a fantastic option for people that don't have access to a bank. It's the whole, how do we get, how do we get a unit of value that can be spent anywhere in the world into the hands of someone that can't get a bank. They can't get a bank account. Well, all they just need a phone to basically hold their wallet, and they can have Bitcoin or another crypto on their phone. So it is really equitable in regards to helping people that can't get a bank account actually have a way to store value and spend value globally.
And I guess the flip side of that is, so yeah, like while it provides, I guess, more access for more people, what are some of the downsides?
The downsides are if you don't know how to do it properly, you can lose everything. That's the downside. See, this is more of a philosophical question, right? What is the problem with responsibility? Well, you're responsible. And what if you don't know how to look after yourself? Well, that's the whole argument for having various institutions that do things for you. So, that is one of the drawbacks for crypto, is that, well, yeah, it puts 100% responsibility and power into your own hands. You're completely sovereign. So the potential risk that you've got, if you've not learned how to do it properly, is that you, for example, could have a wallet. I've done it. I had a wallet, had some Bitcoin on it. I lost my private keys. Private keys is basically the password, right? I lost it. It's gone. And, it's just something I'd rather not think about because it makes me sad.
So how do you protect yourself from becoming a victim to that? Like, so where do you store your password? How do you do it safely? How does that work? Because once you forget, it's gone.
That's it. This is a really good question, because this is the education piece that people need, right? So there's different ways to store your digital currencies. So there are what are called hot wallets, and a wallet, by the way, is like an account, right? It's like I've got a wallet address. That's basically like my bank account. You can send crypto there. Send me crypto. I'll take it. And you can have hot wallets, which mean that they're connected to the internet. And you can have cold wallets, which mean they're stored on, where's my ledger? Somewhere, but you can have a cold wallet that's not connected to the internet. So when you think about security for your funds, the gold standard, the absolutely unhackable, untouchable, your funds are super secure, no one can touch it. You'd have your Bitcoin or whatever stored on a cold ledger, right? On a cold wallet. That's something that's not connected to the internet. You'd then connect that to the internet whenever you want to spend funds, right? Then you've got hot wallets, right? Hot wallets would be something like, on my phone, I've got an app called MetaMask. MetaMask is just an application where you can have a wallet stored on it. You can access your funds. But the risk is that it's connected to the internet. So hypothetically, it could be hacked, even though it's not very likely, unless you click on random suspicious links or you give people your private keys. So I said, this comes down to
that can happen. Sorry to interrupt. Is that the only way that can happen?
Absolutely. So it all comes down to your private keys. Your private keys are your passwords. So, the only way that people can hack your wallet is if they know your private keys. Private keys there's 12 words, right? These are very, very hard to hack. 12 random words that you need to put in order to be able to access your wallet. Right. So it's very, very secure, which is why, when people talk about getting hacked with their crypto, typically what they're actually saying, without the nuance, is that they had crypto. This is the next version of how you can store crypto. They had their crypto stored on a custodial wallet. So for example, you've got platforms in Australia, such as CoinSpot, where they're like big crypto exchanges, right? What they provide for you is a custodial wallet. So basically you log into CoinSpot, you just use a regular password, right? Like I'd type in my password on my computer, that accesses all of my funds there. Now they have my keys, they have my private keys, they've got everything, right? So what could happen is that hackers hack an exchange and then they get funds. So they haven't actually hacked your wallet, they hacked the exchange, right? That's why, when you do start to accrue your wealth in crypto, it makes sense that, whatever you want to trade or do whatever you want to do on an exchange, have that there. But, what we do is we keep the bulk of our wealth on a cold storage device or a non-custodial wallet. So a non-custodial wallet just means that I've got my private keys, nobody else has got my private keys. Therefore, that's very, very secure.
Except if you forget.
Except if you forget. And once again, then that comes down to preparation, right? So, what I've got with my non-custodial wallets and what I've got with my cold storage is like I've got two versions of my private keys written down on paper, stored in somewhere safe. And like, I know where they are. They're there. I know they're there. And if I ever need to access it, they're there.
Okay. All right. I just want to make sure if anybody has any questions that they feel free to ask. So before we go any further, are you guys good? Do you have something you want to ask at this point?
I do have one question,
Okay.
Todd. So I've got a
Yes.
Coinbase account.
Yep.
And I've got some crypto in there, and I've just realized that I don't know what my passwords are. Would they be stored in the app?
Correct. So Coinbase they're very large. They're I think they're on the New York Stock Exchange. I think they're a public company. They've got really good security, but they are a custodial wallet. So custodial setups like that have got institutional grade security, like they're pretty good. You know, where we start to see this hack stuff really start to happen is where people are playing with these new, like unheard of dexes, like decentralized exchanges or scammy looking sites, right? And what they do is they interact with these platforms and they get their wallets drained. But when you're playing with like these big names like SwiftDex, CoinSpot, Coinbase, like they have got entire teams that are just focused on security. So your funds are pretty safe. But that's a really good example of a custodial wallet. They're great because it helps the average person get involved in crypto without having to learn all the complicated stuff, right? And what you'll see, the average person, if you look at like the cycle of development in regards to when people come across Web3, typically you start with custodial setup, right? You play, you buy some tokens, you do some trading, all that kind of good stuff. And then as you keep learning more, then you might, you know, oh, hey, I'm going to get my own MetaMask, right? And then that's the next stage. And now you've got your own private keys. And then the next stage after that, you're like, hey, whoa, I might get myself a nano ledger. And now you've gone from custodial hot wallet all the way up to a literally super secure cold storage unit.
Okay,
Does that answer that question?
Yeah, absolutely. And I'm definitely the average, certainly not at any level like you're saying there. But they would have the keys in there in the app. Like I'd be able to find them in there if I was looking through.
Yeah, to the best of my knowledge, to some of the platforms, you have to check with Coinbase. I don't personally use Coinbase. Some of the platforms allow you to request your private key. And you can basically get that out. So you can actually request those. But my recommendation, Deb, always is if you've got like lots and lots, look, once again, I repeat again, because, you know, we're 13 years into this, these big companies are pretty secure. So it's nothing that people need to worry about in regards to, you know, oh dear, Coinbase is going to get hacked and all my funds are going to be gone. The likeliness of that happening, you know, I don't perceive it as being that high. Like I've got, you know, good sums of money stored on CoinSpot wallets, right? I just don't have all my funds there. The risk happens though when people start playing with these weird sites, right, that just pop up out of nowhere, offering like 200 million% gains, and next thing you know, all your crypto's gone.
And it's quite simple to transfer your hot wallet to a cold wallet. Like, is it quite a process, or is it pretty straightforward?
No, it's very easy, Elise. So all you do is effectively, you know, just like on Coinbase, you can basically send people funds. Yep. All you do is you're just, for example, on MetaMask is a great example because it's so easy to use. On MetaMask, you could create a brand new wallet in approximately 5 minutes. You'd copy your personal wallet address and you would paste that into CoinSpot and you would send yourself funds.
Yeah, cool.
Yeah.
Cool.
So,
yeah.
and what you've then done, right? You've not gone from hot storage to cold storage. You've gone from a custodial wallet to a non-custodial wallet, which means now you 100% own your crypto.
Cool. Awesome. Thanks.
Yep.
I guess that sort of introduces the conversation about which cryptocurrencies are safe to invest in, and how do you sort of, I guess, make a healthy decision around that, because there's a lot out there, and like you said, people professing to be able to provide these massive returns. How do you sort of spot where the downfalls or the pitfalls may be?
Yeah. Well, look, as I said, I'm on the spectrum of Bitcoin maximalism. So I would always recommend people to, there's a saying, it's called stack sats. So a Satoshi is like a denomination of one Bitcoin. I think it's 100 million Satoshis per one Bitcoin. So it's like stack sats, get as much as you can. Bitcoin's always going to be great in my opinion. But I think when it comes to purchasing various digital currencies, I always look at, well, what's the use case of what's the promise of the project? You know, because for me, Bitcoin is the evolution of money. So that's why I buy Bitcoin, because for me, Bitcoin eventually will be one of the best stores of value that we have in the world. And it's mine, nobody can take it. So that's why I buy Bitcoin. But then when it comes to purchasing other tokens, it's like, well, what's the project doing? So like crypto.com, I bought their tokens. And the reason why is because they've got a really cool project. They do some cool stuff, right? They've got the crypto.com Visa, MasterCard debit cards. They're really, really cool. I bought some tokens in this thing called Quaint a couple of years ago. And they're just like a blockchain solution company doing some cool stuff there. So to answer the question, I always look at 1, the project, 2, the promise, 3, the team, 4, have they got any traction, if anything at all? And then if that all resonates with me, I will then invest whatever I'm prepared to lose.
Okay.
Sorry, on that note, like Todd, Bitcoin has pretty much halved in price in the last year or so, hasn't it?
Yep.
So it's gone down from 60,000 to about 30,000.
Yep.
And that's happened with a lot of the cryptocurrency. What is, because it's kind of, has it reached its peak and it's now simmering down to what is a manageable level, or like what's going on that front?
Yeah, this is great. For me, you know, I always want more money. And the reason why I want more money is so I can buy more Bitcoin. Like that's all I can think about. Whenever I see the price of Bitcoin drop so low, I'm like, oh my God, this is like a sale. This is a Black Friday sale. Because, you know, this is an important understanding when it comes to thinking about getting involved in digital currency. What's your time horizon? Like, are you looking here or are you looking here? Because for people that got involved in Bitcoin back in 2016 at $900, like right now, they're like, I'm good. The people that are a little bit, you know, how you doing, are people that bought at 60,000 and it's dropped back down. But once again, if you then scale that time out again, if you look at the rise of Bitcoin over the years, it goes through these cycles. So, you know, to answer the question directly, we're just going through the next bear market. I have 100% confidence that everything's going to bounce back. 2023 to 2024, we've got the next Bitcoin halving. For those who don't know, every 4 years, roughly, the amount of Bitcoin that gets circulated from people that are mining cuts in half. Every time there's a halving, Bitcoin's prices typically shoot back up. So to answer the question, we're just going through a bear market that is just reflective of all the things, right? COVID, lockdowns, supply chain issues, Ukraine, the gas stuff with Russia. So there's all these market forces that are pushing prices down. But, you know, at the end of the day, my opinion is that it all will bounce back again. So I'm just making intelligent purchasing choices right now while things are so cheap.
Do you spend any of your Bitcoin? And if so, what do you spend it on? Like,
I ideally would rather not, but you know, Bitcoin can be spent in various places. Like I walk down through the Gold Coast up here in Queensland, and there's lots of little restaurants and various like supermarkets and convenience stores that have got Bitcoin accepted here. Went to a tattoo shop said Bitcoin accepted here. That was pretty cool. You know, not lacking in tattoos. So there are lots of different places that do accept digital currency. But once again, for me, Bitcoin isn't a spending thing. I don't want to spend my Bitcoin. I would rather buy Bitcoin as a store of value, so to preserve my wealth.
Okay. You did mention mining.
Yeah.
What is mining?
So this is a good question. So we've got this blockchain tech, right? And the question people have, well, okay, so it's all decentralized. How do we verify transactions? How do we make sure that it's accurate and authentic? So what miners do is miners basically buy computers, right? That are pretty dang expensive, and they effectively use their energy and their computing power to solve ever increasingly difficult equations, right? That's like, for example, how Bitcoin works. You've got this difficulty algorithm that adjusts based on how many people are trying to mine. So if you've got lots and lots of people trying to mine and there's all these transactions occurring, the difficulty level to solve an equation goes through the roof. You have to exert more computational power. If the amount of people using the network decreases, the difficulty algorithm decreases with it. It goes up and down based on output. That's the first thing. So this is why I like mining. So mining is, when you think about it, right, the way that mining is the way that blockchain transactions are verified and the way that new coins are added into circulation with various chains such as Bitcoin or Ethereum. And the reason why mining is great, because it's like a circle, right? So the miner maintain and secure the blockchain, and then the blockchain rewards the miner for their effort with new coins. Those coins are effectively the incentive for miners to do their thing. And then the other thing that's built into crypto, which is really good, is a disincentive. So the incentive to secure the network is that you get the coins. The disincentive to do the wrong thing is that if you tried to fraudulently validate a transaction, that would damage the network, which would mean that you damage your own value. So there's a nice loop. There's an incentive and there's a disincentive. But mining, to answer the question in short, is the way that we secure the network and verify transactions.
Okay. NFTs. Go there.
Hey, NFTs there. So look, NFTs are the latest buzz, right? Me personally, I haven't bought any NFTs. I know plenty of people that do, and the power to them. But the NFT, if you look at what it is, the definition of an NFT, right, is it's a non-fungible token. So Bitcoin is a fungible token. What that means is one Bitcoin is one Bitcoin. I can send one Bitcoin to you and you'd be super happy because, well, hey, you just got 30 grand. And you can send one Bitcoin to me and it's always the same. I can send half a Bitcoin to you and that's the same as somebody else's half a Bitcoin. So it's exchangeable, it's transferable, it's the same. Non-fungible though, on the other hand, is there's only one of its kind that exists and it cannot be replicated. So that's what a non-fungible token is. So you can use NFTs to represent real world assets, right? So you can have an NFT that represents artwork. You can have NFTs that represent real estate. So over in the United States, there are some cool companies that are effectively taking the deed of a property, putting that on chain in the form of an NFT. That way, when I transfer the NFT from me to you, you've now got that verified representation of ownership of that property, and it can't be replicated. It can't be fraudulently remade. So that's what an NFT is. There's different ways that people use it, right? NFTs can also function to represent individuals' identities, right? So you can basically have all of your identity information stored in this token, right? And it can have everything about you. It can have property rights. It can be used as collectors, right? So if you own a certain piece of artwork, that you own it, that token can represent it, right? And then if you kind of go out to more abstract things that are happening right now, you've also then got the NFT artwork space, which is like all those monkeys that you see all around the place, right? Bored apes, they're called. Look, once again, not my cup of tea. I don't necessarily see the use case there, but there's a serious use case for NFTs. Like let's say, for example, we chat about this earlier on, Stace. So imagine you're a business and you wanted to, well, where's my camera? There you go. Imagine you're a business and you're like, geez, well, what could I use this crypto and NFT stuff for? Well, imagine that you had an NFT that represents a certain level of membership with your business, right? And then what you do when people join this as a member, instead of having like an old school record to make it modern and fresh and unique, you could actually give them an NFT, and everyone that holds that NFT, right, they're now entitled to XYZ benefits in your business. Like that's something cool you can do with NFTs. Yeah, you right.
does it have an expiration date then? Like, could you so yeah, I was just trying to think in a real world application, for example, for the chamber moving forward in a future digital economy, how would that look if you were trying to, provide, I guess, an NFT as the membership, as proof of your membership? How do you, how would that work?
Well, this is a cool thing too. All of this stuff that we've been talking about right now, like, NFTs and all that kind of good stuff, very, very programmable. So you could program into that token an expiry date if you wanted to, right? You can program what you want into the smart contracts, and it can function. This is where the thought comes into it, right? What exactly do I want it to do? And then all you do is you get a blockchain developer to help you build out those functions. Highly programmable, which is great because that decreases inaccuracies, error, and speeds things up very quickly.
Okay. Stable coins.
Well, look, stable coins are the digital currencies world, the digital currency world's way of bringing some stability into the mix. So it's in the name, stablecoin. So it's effectively a token that is effectively anchored or pegged to a local domestic fiat. So currently what you've got USDC, USDT. They're the two biggest stablecoins in the world. They are anchored to the price of the United States dollar. Now, these coins are also what are called asset-backed stablecoins. So what that means is that for all the USDT in circulation, and let me quickly pull it up right now and I'll tell you how much USDT is in circulation. So there is in circulation. Let's find out how much there is. USDT in circulation. Okay, so for context, there is currently 68 billion dollars worth of USDT in circulation right now. And that $68 billion worth of USDT is asset backed. So what that means, and what that does though, is it creates confidence for people. So if I'm holding USDT, I know I can go and I can put that on an exchange, and I can effectively turn that from a crypto token back into AUD. It's asset backed.
Okay.
Allows people to trade, allows people to hold. For example, if you've got $60,000 worth of Bitcoin, you got one Bitcoin and it's at a high, it's at $60,000, right? And then you see, oh dear, the market is crashing. It's gone from 60,000 down to 50,000. Oh Lord, no parachute. Well, you do have a parachute. You take your Bitcoin, turn it into USDT. That now is not volatile, doesn't change. And that's a way that you can protect yourself when things go volatile.
Okay. Deb, do you have any other questions? No? So I just want to ask because it's also overwhelming for the average person, what are some of the steps for a beginner to get started in this space? What should we be thinking about?
Yep. So look, the first thing is just like jump on YouTube and just have a look, how to create a wallet, how to get involved in crypto. Like they've got these cool videos on YouTube. They're like whiteboard drawing videos. Great. I love them. I love watching those because they draw complex ideas for you and you learn it very quickly. But that'll be the first thing. Just get educated. The second thing is just go and join up to a platform like Coinbase or CoinSpot or SwiftX. They're great. SwiftX is an Australian company. They've got their office up here in Brisbane. I did a podcast with them a couple of weeks ago. But join up to a custodial service like that and just purchase some tokens, have a play with it, right? And you will start to learn the whole thing. It's actually the learning curve. It seems scary when you're just looking at it from the outside, but the moment you sign up to a platform, you buy some tokens, you send your first tokens to another wallet address, like you get it very, very quickly. I reckon you do 5 transactions and you're going to know how to send and receive crypto. It's that simple. Everything else is just extra, because then we start to move into the next level of it, right? Which is decentralized finance. And we talked about this before the call. Like, why should you care as a business? Well, yeah, we talked about reward systems, membership levels. Like imagine having a reward system built on crypto. So people come and they spend with your business and it gets spat out, this cool token that can specifically get used again at your store. Now, once again, that is just an evolution, a Web3 version of, a standard reward system, but it's cool. It's unique. People love it. Decentralized finance. So what we're doing right now, we've got another part of our business called B for Finance. And we effectively provide crypto-backed lending. And we do house mortgages, so crypto-backed mortgages for people wanting to buy homes, but we also do business lending and personal lending as well. And what we let people do, and this is where the DeFi lending space comes really cool, is you can effectively have some crypto. So I've got $10,000 worth of crypto and I don't want to sell my crypto because I get capital gains. Instead, what you can do is you can lend it. So I need, cash right now. I need $10,000 AUD. With our lending, what we do is you give us $13,000 worth of your crypto. We lock it up for 48 months. We give you that $10,000 cash. You spend it how you want to spend it. At the end of the 48-month term, you just pay it back, right? If you don't pay it back, we can just liquidate your crypto. If you do pay it back, you get your crypto back. So like there's really cool ways to access finance without having to go down the traditional bank routes, because what are banks charging now for business finance? Like it's above 10%, isn't it? It's like huge. Not just that, you need to prove your credit history, your income, jump through all the hoops just to get business finance. So what DeFi does is it gives you a way to access finance without the bank to fund your business. But I could go on for ages about that because that's really, really cool.
Yeah, it's a game changer.
Yeah.
You were recently, we were talking about before, at the Australian Crypto Conference on the Gold Coast. And what were some of the biggest takeaways for you?
Wow. So yeah, the Australian Crypto Convention was Australia's largest ever convention for crypto. 2 days. I think there were 90 talks that were done, 64 plus exhibitors, 4,000 attendees over 2 days. It was huge. Biggest takeaways is that, we're in a bear market right now. And despite being in a bear market, that place was absolutely packed. And what I found really interesting is that, let me ask you a question, Stacey, when you picture a crypto convention, what kind of people do you imagine being there? Describe the kind of people, like visually, what they would kind of look like to you. What do you expect? What's your expectation?
I don't have a visual. You? I don't know.
Ben just said kids. Yep.
Yeah,
Anything
definitely
else?
a younger demographic. Yes.
I tell you what, yes, there were younger people there, but there were lots and lots of people that were between the age bracket of 35 through to about 60 years of age. Oldest person I spoke to there would have been in his 80s.
Yeah.
Like old dude. And he's like, tell me about the crypto, man. like it blew me away. So I think that was probably one of the biggest takeaways for me, was that there is a growing amount of interest, not just from the younger demographic, but also everyone in between that are looking at how they can, bring Web3 into their life, for their business, for their finances, as a way to store value. And there was a lot of interest there from a whole range of different kinds of people.
Do we have any idea of the kind of percentage of Australians who are starting to become investors?
There definitely are those figures. I can't recall those ones off the top of my head, but I think, I can't even remember. I've read them recently, but I can't remember what they are.
Okay. So this is the first of a 3-part series we're going to do on this topic. What can we expect going forward from future episodes?
Yeah, so look, today was more so just my best attempt at keeping this as non-technical as possible and trying to keep it relatively beginner friendly. I apologize if I spoke too quickly.
No, you did great
at that.
Yeah.
But what we'll go to is more intermediate level stuff. So in the next session when we get around to it, start looking at, I've talked about decentralized finance right now. I love decentralized finance. It's literally you becoming your own bank. It's some cool stuff there. So in the next episode, we look at kind of DeFi, plus talk about some real world applications that are happening right now around the world that are really cool to get involved with.
Okay. And hopefully by our next chat, I'll have got my own digital wallet.
yeah, just go sign up for SwiftX. Takes 5 minutes and boom, you're done.
Yeah, awesome. I'm just going to stop our little recording. There we go. Yes.